Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, September 11. You're tuned in to On Trend, the show designed to keep you on the right side of the trend. So we're going to start off with a bit of a macro outlook here. We're going to look at stocks versus bonds. We'll look at some of the rest of the world, Germany, China, and EEM. And then we're going to look at some sectors. We'll look at some industry group ETFs. We'll show you some industry group ETFs that are clearly not on trend. We'll do some Q&A, and we'll finish with a bunch of stocks to watch. In particular, we got some Bollinger Band squeezes and strong uptrends to show. So basically, stocks are still outperforming bonds, and that means risk assets are still preferred over safe haven assets. All right, so we're going to start off with a simple ratio chart, and I think this is a great chart to tell you whether the market's in a risk-on mood or a risk-off mood. It's basically stocks relative to bonds. I'm using SPY for stocks. I'm dividing that by IEF, which is the 7 to 10 year Treasury bond ETF. The reason I chose IEF instead of TLT is just because IEF is kind of like in the belly of the curve. I think it is the most active bond area of the market. I'd have to confirm that. Whereas TLT is going to be the most sensitive, definitely, to any change in the outlook towards interest rates. But I think the 7 to 10 year captures it pretty well. And you can see here that stocks outperformed bonds from October until January. Then they had a very choppy underperformance period there into March. And since April, stocks have been outperforming bonds. All right, we have a bunch of higher highs and higher lows. And as showed on a regular basis since May on the chart for the S&P 500, there's the breakout that we had basically. Well, if you look down here at the bottom, we have SPY, and we had this large triangle. And there in May, we had that triangle breakout. And ever since then, we've been outperforming. And as long as stocks are outperforming bonds, I think that is a net positive for the broader market. It doesn't show that there's a lot of fear out there. All right, if bonds do start outperforming stocks, then that would be a different story, but it hasn't happened yet. And what we need to say to see this ratio turn down maybe and break below that August low to start being concerned. Now, another way to look at risk on and risk off would be to compare junk bonds to treasury bonds, because junk bonds, of course, they're at the bottom of the junk bond pile, or at the bond pile, if you will. They are going to be the first ones to default if there are any problems in the economy or the credit markets or what have you. So they are really the canaries in the bond coal mine, if you will. And as long as junk bonds are outperforming treasury bonds, that's also a net positive for the financial markets. So in this chart, I've just got a simple J&K IEF ratio. All right, so that ratio moves higher when J and K, the numerator, rises at a faster rate than the denominator, IEF. And we can see we've had pullbacks along the way, which is normal, but clearly the trajectory here is up, and it's been up since October. All right, even in this early part of the year, we recovered quite quickly, and that ratio moved to a new high there in May. So it's clearly been risk on as far as junk relative to treasuries. And again, you know, we can watch that August low maybe for the first signs of any deterioration in the credit markets, which might affect the stock markets eventually. But right now, I don't see anything that says there's a risk on mood out there. So now let's look at the TLT chart, and I'm going to show you three different perspectives. First, we're going to look at a monthly chart going back 10 years, then we'll look at a weekly chart, and then fine-tune it with a daily chart. But if you look at this monthly chart, all right, we had a huge advance in bonds from 2010 until 2016. During that period, we even have a 17-month downtrend. So you can see there can be some pretty long counter trend movements in bonds. All right, this was 1, 2, 3, 4, 5 months. And this was, well, the current move is 24 months since the peak there in the summer of 2016. So basically you had a little counter trend bounce, a move down, and now we're consolidating. And look at this support zone. If we break 115, that opens the door to multi-year lows in TLT, and that would be, well, it'd be obviously quite negative. I'm currently bearish on bonds, so that means I would favor a support break here and a move lower in Treasury bonds, which means a move higher in Treasury yields. Now let's look at a weekly chart to fine-tune this one notch. So there's the peak there in July 2016. Then we had a counter trend move. You can see you reverse near the 50% retracement. So this is like 2 steps down and then 1 step back up. And now we're starting on another move lower because we broke down here in the early part of 2018. Now we haven't moved lower because we consolidated, but I will expect to move lower unless we break above 123 here. And now if we look at a daily chart, I'll show both IEF and TLT for some granularity on both. Well, we can see a clear resistance zone here for IEF. And note, I am using unadjusted data for both IEF and TLT, and that means I am not putting back in the distributions because bonds, of course, have relatively high yields, and those distributions do affect the chart. I would rather see the chart without distributions. If you want to learn more about that, look at last week's video for an answer. But basically, as long as we hold below resistance at 103, 103 and a half, we'll call it 103. All right, if we break above 103, we have to reevaluate. And if you look at TLT, there you can see we failed once, twice, 3, 4 times at this resistance level with this downturn that we had over the last 2 weeks or so. So that tells me money is moving out of bonds, and that money has to go somewhere, and I think it's a benefit to the stock market when bonds move lower. And also when bonds move lower, Treasury yields move higher, and that is usually a positive for the finance sector, but if we have yet to see the finance sector benefit from that or take advantage of it or move higher because of it. So that's another case in point where if you're interested in XLF, look at XLF and keep this other stuff on the back burner because there are so many issues out there. We can't possibly know them all, understand them all, or even weigh their effect on a particular sector. That's why I think we're usually just better off looking at the XLF price chart and keeping that other stuff on the far back burner. So I've got one more chart here related to treasuries, and this is the yield curve, if you will. On this top chart, I've got the 3-month yield at 2.14%, the 2-year yield at 2.73%, and you can see that 2-year yield hit a new high yesterday. And so there's just a clear uptrend in the 2-year yield. And as long as that uptrend is there in the 2-year yield, I would expect the Fed to continue tightening. I don't know at what rate they're going to do that, but yields or the yield curve usually leads the Fed. And so if the 2-year yield is rising, that implies higher rates down the road. And we can see the 30-year turning up a little bit, 10-year turning up a little bit this week. And we look at the yield curve, we can see the 10-year less the 2-year. It's been tightening over the last year and a half, 2 years, but it is still positive, okay? That means the 10-year yield up here at 3.09 is well above the 2-year yield at 2.73. China, Germany, and emerging markets weigh on the world, but they are not weighing on the USA yet. So I pointed out some European indices last week, and I'll point out the DAX again today, as well as the emerging markets index, and we will look at Shanghai, because we can see that the DAX has a big head and shoulders pattern brewing, and that's a big distribution pattern, and it's testing neckline support, and a break here would be bearish for the biggest index market in Europe. So if the DAX breaks down, that would clearly be a negative for Europe. And you can see the DAX is underperforming because it's well below its 2018 high, has a lower high here. So it's one of the weaker groups out there. Now, the next one to look at would be the Shanghai Composite. So the Shanghai Composite is in a serious downtrend. You know, it took this big hit in 2016 and then worked its way all the way back up, didn't quite hit a new high, had the breakdown there in January, a little bounce, and then continued lower. and it is down around 20% from that February high. And if we look at the S&P 500 here, and we'll do that March high in the Shanghai, it's down around 20%. And we can see the S&P 500 is up 13% during this time frame. And so do we want to be in Chinese stocks? Well, no, clearly not. Look at this. It's not on trend. There are other trends to be found out there. Now, the bigger question is, as far as I'm concerned, is this going to affect the U.S. markets? And the answer to that is, well, it won't until it does. And I'm sorry to sound like sarcastic, but that's the way these things work. You know, who knows why Shanghai is declining? All right, but it is declining. It tells you this is not a place you want to be right now. The U.S. market is advancing, and so it is still a place that we want to be. And clearly, this decline in Shanghai is not affecting the U.S. market right now. Here's the emerging markets index, and it was leading in 2016 and 17 there. And then you can see it broke down in the early part of 2018 here. Actually, that's April, May when it broke support. So it's down around 17% from that high, whereas the S&P 500 is up around 13% during that time frame. So do emerging markets affect the U.S.? Well, clearly not in this case. You know, we've seen here that they can rise together, all right? And the U.S. can still rise even when emerging markets fall. So will this ultimately affect the U.S.? I do not know, but I think if it does, it will become apparent when we look at the price charts for the S&P 500, the NASDAQ, and we look at the breadth indicators. That's where we're going to see the real evidence of selling pressure. And so I wouldn't worry about it until we see something happening on the charts based on the U.S. indicators and evidence. And since I'm on it, I'll just show a chart for EEM with the dollar. This is the emerging markets ETF. All right, and there you can see the big advance. And then it was hit hard in January. That was no big deal. Bounced, but then it moved down and broke support. So that is a big deal. 50 days below the 200-day. And it's been lagging. Look at this, lagging the U.S. markets since March. And part of the reason is the strength in the dollar. So there in the bottom window, we can see the dollar moving up and EEM moving down. And we can also see in 2017, EEM had it good when the dollar declined, and that boosted this ETF quite a lot. So as long as the dollar continues higher, I would expect EEM to move lower. Industrial staples and utilities are leading in September. All right, so I'm going to look through the sector SPDRs right now, but I'm going to do it in a couple of different ways. We're starting off with a candle glance chart group of the S&P 500 sector SPDRs. And just to show you how I've created this list, if you see up here in the middle to the right, you have the Edit List button. And I click on that button, and there you can see this chart list that I've created. And I put some numbers to precede each of the names, and that preserves the order because I want to see consumer discretionary, technology, telecom services, financials, and industrials at the top. I think those are the four offensive sectors. Healthcare is next because it is the third biggest sector, I believe, in the market right now. That's going to change when they back out telecom services from technology and consumer discretionary, but that'll happen in about 2 weeks. And then I've got materials and energy. And at the bottom, I've got staples, utilities, and REITs. All right. But I think that these five are the main ones to watch because they account for over 75% of the S&P 500. And so they're the ones really driving things here. So once I've got this chart list made up, I can view the list as a number of different ways. So I click the drop down there, and I'm going to go with Candle Glance. And that's going to give me up to 30 charts per page. Now, in this example, I'm only going to have 12 charts, all right, because what I've got here is I've got the 11 sector SPDRs plus SPY, and I'll show you why I put SPY in there for a minute, but, you know, just some basic chart analysis, SPY, uptrend, all right, it's in the middle of a pullback within the uptrend, but it's a pretty mild pullback so far. XLY, similar situation, strong uptrend, a little bit of a pullback underway. You know, you see kind of a consolidation area. maybe we get down to that 112.5, 113 area. Technology, a strong uptrend. So technology, consumer discretionary, and down here, healthcare show the strongest uptrends since May right now. And you can see that technology is pulled back here, and there's an area of support coming into play right now in that 73 area that may give way to a bounce. All right, then we have telecoms or communication services here, which is getting off to a rough start. All right, it's one of the weaker ETFs right now. And of course, Facebook is one of the stocks weighing there, as well as Twitter. We look at financials, still struggling to get above this resistance level. All right, you got that big surge here, and now it's kind of slowed a little bit. And I've got a support right there. Should be straighter. Right there, just above 27.5. You can call it 27.5 to have a buffer. But still the cup is half full, I think, for financials, unless we close below 27.5 there. We look at industrials. Now this sector actually moved above that late August high. And I think it's the only sector to move above that late August or September 2nd or whatever high it was. So industrials are showing strength here in September. Healthcare is looking very strong, but overbought and ripe for a pullback. Materials are not on trend, so move on to the next sector. Energy, I hate to say I'm giving up, but it's not on trend. I was looking for the, bounce, and when it became oversold, and it got the bounce, but it's right back down to these levels. So, basically we have a choice when we're looking at these sectors, and we're looking for the stronger trends out there. Will they last forever? No. One of these days the trend is going to bend, it's going to break, all right, but we don't know when. But I think it's better to stay with the stronger uptrends if you're looking for something rather than trying to pick the weaker ones to rebound. And right now, XLE is not one of the stronger ones. It's one of the weaker ones. And so is XLB. All right, now moving down to the last three that you see here, we've got consumer staples, utilities, and REITs. And staples have had a nice big run here, and they are bullish as long as they hold 53. Utilities as well have had a big run since June, and they are bullish as long as they hold, well, we'll just say 53 to keep it even with XLP. And REITs have had a nice run, and they are still in an uptrend here. Now I want to show you what we can do once we have a list here. So I've gone from candle glance, and now I'm going to go to the summary format. And in this format, I can see a ranking, and what I've got is intraday, which would be yesterday's price action, but I'm going to change that to 1 week. All right, and then you can click any of these columns to sort. So I can sort by percentage change, which it is now. I can sort that with the worst at the top, or I can click again to get the strongest at the top. And the strongest over the past 5 days, which is September, are utilities, staples, and industrials. And financials actually are holding up well in September because they are down the least of all the sectors that are down. And then on the weak side, we can see telecom services and technology weighing on the market, energy. And then, I consider these negligible declines in the other ETFs. But, 2% declines in these three is something to speak about. Now, before I move on here, there are a number of different options that you can use here for these lists that you create. I could put them in an RRG chart, and then I could see how they all compare to the S&P 500. All right, if you like to use RRG, that's a great way to put a group in and then look at that group. And I could also go to Market Carpet to see how they are performing. And I can also select an indicator up here. I could select RSI, for example. And if you right click, you can show the ticker so you can see the ticker in each of these boxes. Now we're going to turn to some industry group ETFs that have caught my attention. So the first one is Sky Cloud Computing, and say what you will about these ETFs, overbought, extended, ready for a correction, But SKY is still one of the strongest ETFs out there right now because it hit a 52-week high there at the end of August. It's pulled back a little bit, hasn't quite gotten oversold. I would like to see it in that 30-35 area to be properly oversold, but there is no denying a strong uptrend here. Next up, we have Hack, and Hack was one of the best performers in the early part of 2018. I mean, there's when the market got hit, and it moved to a new high in March, and it's continued to move higher. And it had this kind of, zigzag correction, if you will, and broke out. But what's impressing me is, technology was hit, but Hack here is staying above its breakout zone and consolidating, so it's acting like it wants to continue moving higher. Software remains one of the strongest parts of the market as well. Just a continued zigzag higher with a new high about a week and a half ago. It got hit a little bit 4 days ago, but then rebounded. There's still a strong uptrend here. We don't have a mean reversion set up because it didn't pull back much, but it's still a strong uptrend and there's no signs of weakness on this chart. So the IBB Biotech ETF is at an interesting juncture because, first of all, the bigger trend is up. You have a breakout to new highs. So we had this big surge from like 115 to 122 and a pretty hard pullback, but hard pullbacks happen when you're dealing with biotechs. But what's interesting is you're in this zone where the apex of the triangle is. So there's a lot of congestion in here, and that suggests that it's a support zone. So I'd be watching for a potential bounce off of this zone. So earlier I showed the communication services sector, which is getting off to a rough start. But the telecom ETF is performing quite well since April. It was one of the worst performers in 2017 and into April 2018. But then it kind of started turning up, got a breakout, a throwback, and then a surge to new highs. So telecom is looking strong here. And finally, for the bullish ones, we have the MLP ETN, AMJ. And it took off from April until early August and then has kind of a wedge decline working here, correction, I think, within an uptrend. And you've got a little consolidation down here. And if you break above last week's high, I think that's going to be a bullish indication within that wedge. And that could lead to a bigger breakout and new highs in AMJ. Now, I know I just showed a bunch of uptrends, but there are still pockets of weakness, and I'm going to show some industry group ETFs that are clearly not on trend. So the first one up is ITB, home construction, clearly not on trend, so one to stay away from. I kind of pointed out this pop here, but it didn't work and it dropped, so it is not on trend. We look at broker dealers, not on trend either. A lower high here in May, June, and testing these lows here, but broke that channel. So looking weak in broker dealers. You look at E-Trade and TD Ameritrade, they broke down. The first solar ETF kind of following the Chinese lead with that breakdown and move to new lows. XES, the Oil and Gas Equipment Services ETF, I thought it was going to break out a couple times, but it didn't. It's not on trend. Don't try to think otherwise, all right? I think I made that mistake earlier thinking it had a chance because of oil, but you need to look at the actual ETF, not the derivative of the ETF. In other words, don't look at interest rates when you're dealing with charts for banks, and don't look at oil when you're looking at charts for XES, because clearly there's a disconnect here. You'd be better off just paying attention to XES and not knowing what was going on with oil, because XES is not on trend. Coal, not on trend. Head and shoulders reversal working there and breaking down. Copper miners, 52-week lows, not on trend. Gold miners, stay away, not on trend. Metals and mining ETF, it broke down here in July, had a little bounce and breaking down again here in late August, early September. And steel doing the same thing, not on trend. So there are clearly some weak pockets in the market, and those are the ones to be avoided right now. All right, if you have any questions, comments, or feedback, you can always send an email to askarthur@stockcharts.com. Can't answer them all, but I will go through them. The first question is, how do you pick mean reversion setups and set profit targets? That comes from Jim D. So let's look at an example here. So this question is based on a scan that I showed 2 weeks ago in On Trend, and basically looking for stocks that the 50-day EMA is above the 200-day and RSI is crossed above 30. And if you run that scan today, you're going to see these holdings. Now this is just the first cut, okay, if you will. You always have to look at the price chart. So you can see Facebook came up. So if we click on that, we can get the price chart for Facebook. So this is how I find the mean reversion setups. I'm looking for an uptrend, but I'm also looking for stability of trend. All right, and if you look at this trend, it started to get really unstable there in March. All right, you had that big breakdown, but then we had to move to new highs. And then we had this big gap down. And I asked myself, well, is this a stock I want to be messing with? You know, it goes from 150 to 215. That's like 33%, and back down to 160. And because of this gap down, I think it's not a very stable stock, and it's not one I want to be messing with for a mean reversion trade. Now, as far as a profit target, I'll show you an example with Honeywell because it had a nice breakout there, and then it pulled back to the breakout zone, and that was the opportunity to get that bounce off the breakout zone. So you want your target to be obviously above this high here, but once you get to this, you know, above this high around 160, you get above your high and you get near where your profit target is, you need to probably trail the stop or consider doing that after your profit target is hit. And this indicator here is the chandelier exit. All right, and it's going to trail the stop for you. And so if it keeps running, you'll stay in after your profit target is hit. But as far as setting profit targets, a real inexact science, and you just kind of have to use maybe an ATR multiple, maybe 3 or 4 ATR values above the entry price, or kind of look at the chart and find a higher high. And looking down here, there you can see there's the chandelier exit on the overlay section. The next question is, can you reverse engineer an uptrend scan to find downtrends? That comes from Henry D. So Henry is referring to a System Trader article where I put together a scan to find a stable uptrend, and I showed how to use RSI to identify that stable uptrend. And then there is the scan code. And we can reverse engineer that to find downtrends. So in order to do that, we would change this, and we'd want the maximum value of 125 period RSI over the last 125 days to be below 50. And then we want the maximum value of RSI 14 to be below 70. In other words, it never became overbought. And we want the minimum value to be below 30, which means it became oversold. And if we run that scan, you're going to see that we're going to get a lot of results that were stocks in strong downtrends. There you go. General Electric, Goodyear, Newell, Philip Morris. These are all stocks in strong downtrends. So I'm running out of time here on the charts worth watching, but I do have a couple of Bollinger Band squeezes to show you. Now, there are two big banks that are getting the Bollinger Band squeeze. Here you can see Bank of America, and the Bollinger Bands are at their narrowest in over a year here. So we're watching for the direction of the breakout. Up is bullish, of course, and down would be bearish. And then next we have JP Morgan doing the same thing. You can see a Bollinger Band squeeze there on the chart. So you watch 113 down and say 116 and change up. All right, that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend.